Welcome back, ladies and gentlemen, off to the last session for the day before the very prestigious awards ceremony. Now, the last session for the day is themed, How does a good portfolio manager maintain conviction to hold on to winners? And our esteemed panelists are Mr. Ashwin Patni, Mr. Kunal Pavaskar, and Mr. Naveen Chandra Mohan. And Ms. Sonam Srivastav is going to be the moderator for this session. Let me take a moment to introduce our panelists to you, ladies and gentlemen. Mr. Ashwin Patni is the head products and alternatives at Axis AMC. He has joined Axis AMC in 2010 as a portfolio manager and PMS, and later he was elevated to the post of head products. And prior to his engagement with Axis AMC, Mr. Patni was associated with IDFC Asset Management Company as a portfolio manager, structured products. He has also worked with Standard Chartered Bank as product manager, investment services. He's a postgraduate from IIM Calcutta, BE in Metallurgy, CFA, USA. We have with us Mr. Kunal Pavaskar, who joined Tata Asset Management in September 2021 as Principal Officer and Head Portfolio Management Services. And he joined Tata Asset Management from Ind Growth Capital Advisors, a mid-cap and small-cap equities-focused Category 3 AIF. And he brings with him an astute insight into businesses and understanding management. Mr. Pavaskar also keenly studies business and market cycles and is focused on using this knowledge productively in the investment process. He's a postgraduate in management studies from IIM Indore, and over the past decade and a half, he has worked with leading organizations, including In Growth Capital Advisors, Avista Advisory during their partnership with Houlihan Lokey, and IIFL and SBI Capital Markets. A very warm welcome. And now we have Mr. Naveen Chandra Mohan, the founder and principal fund manager at ITIS Capital. Now he is responsible for running the fund and takes all the portfolio and risk decisions at ITIS. Mr. Chandra Mohan has had illustrious career spanning 15 years in the financial services sector, having worked across fund management, fundraising, and fundamental research. He began his financial services career with Lehman Brothers in Tokyo as a senior analyst in the capital markets trading desk. And he has a proven track record of managing money and being ranked the best fund manager between 2012 to 2014 by Asia Hedge in Hong Kong. At ITIS, he runs a growth strategy investing in cash flow-based growth, which provides portfolio downside protection across cycles. Now, ladies and gentlemen, those are our panelists. And now the session is going to be moderated by Ms. Sonam Srivastav, who is the founder of Right Research, where she creates equity and derivatives advisory portfolios based on factor investing and momentum. She has more than 9 years of professional experience in systematic portfolio management and quantitative trading in teams at HSBC, Edelweiss, and QPlum, where she has built and handled large-scale portfolios and trading algorithms. She's a globally recognized researcher in the field of machine learning in finance and quantitative investing, and also an IIT Kanpur graduate, and has a master's in financial engineering from World Quant University. She loves quantitative research in finance and trading, and she's building a business out of her deep passion for quant finance at Right Research. Ladies and gentlemen, once again, I extend a warm welcome to our panelists, Mr. Ashwin Patni, Mr. Kunal Pavaskar, and Mr. Naveen Chandra Mohan, and our moderator, Ms. Sonam Srivastav. Over to you now, Ms. Sonam.
Thank you, Aishwarya. Thank you for this kind introduction. So welcome to our esteemed panel. When we started this session, Kamal approached me and he said that, I sort of have an approach of momentum investing and I'd like to be tactical in my investment journey. Whereas a large percentage of the investors out there, they hold on to their winners, and that is the real joy of investing, right? So how Kamal approached me was that, we should, I should get insight as a momentum investor, what makes, investor, a good portfolio manager, to hold on to the winners that they have. So that is what I'll try to do in this session. Get the insight on, when do you want to be tactical in your investment and what leads you to, really stick to the winners that you're holding, right? To start off, I would just like each of our panelists to, introduce which factors they look at while, selecting high conviction stocks, and what is the typical holding period that you sort of work with. So we'll start off with Kunal.
Okay, thanks. Thanks, Sonam. So to your question, at the outset, I'll also state that at a personal level, I've explored momentum investing from a systematic approach perspective in a good amount of detail. And
Right.
I mean, at the outset, just to say that there are merits and demerits in every single investment style, and one finally has to stick to something that works for the fund manager, the investment team, and obviously the investor who comes on board also has to, in a way, have signed up for that approach and
Right.
understood what are the things that are better maybe in this approach versus the other. Because, and obviously in the end, the aim is to make good risk-adjusted returns in the end in a repeatable way. Basically,
Right.
there's a process that does that. So, I mean, when we at Tata, or even at a personal level, when I've been looking at things, what I think the factors that, and when you say factors, I mean you'll say factors from a probably a quantitative perspective, but when I'm saying factors for a wider audience, it is from a general, when we say factors from an English language perspective. I think two things that can give us high conviction. So first is obviously I think investor communication at the very outset. I'm saying this, which is something beyond portfolio management, but at the very start, if the investor is attuned to what we are doing, I think that is very critical to begin with. So then, whatever pans out is not a surprise. I think that's the first point I'd like to make. And in that, from a portfolio construction perspective, is what I would say as the second point. If you have, I think what works well is if you have probably silos or buckets in your portfolio, maybe that are doing different things at different points because they are invested in different kinds of companies which are in different stages of a cycle. For example, at Tata PMS, when we work with our ACT approach, there are three partitions in that. So there's an all-weather segment, there's a catalyst segment, and there's a turnaround segment. Now, all-weather companies are most very stable, dependable. They're not going to be throwing surprises in the negative direction. The catalyst section is something which will, probably yield results more in the 12 to 18 month period because of some changes that the company is doing, coming from a period where they may have experienced some problems or the business environment is changing. A combination of these turnarounds may be even longer. Now, when you talk about holding period, now the very nature of portfolio construction means that when we enter a company, we are kind of factoring that in already. So I think that is one from a portfolio construction perspective. The other thing also, I would like to say that the holding period sometimes are a function of outcomes. Maybe it's not that we can bake this into the process and say this company will be held for 3-4 years or 5 years. We don't know that in advance actually, because things can deteriorate in the business, in the environment, and especially as tech continues to disrupt multiple sectors, etc. We are seeing a bit more of that. Or for example, in interest rate movements like we're seeing in the last 2 years, or monetary actions change things. We are seeing much more of that. So I think holding periods also are an outcome, something that we can't bake all at the start. Obviously, you would wish for low turnover and things to ride well. And that is where the last point that I like to make is research gives you that confidence to hold on to something. Even if there are, dips that happen along the way or hiccups that the company may experience in business. So the depth of research is what I'd say. So I say, just to recap, I think investor communication, portfolio construction, and the research that we do itself.
Right. That's a wonderful approach. Next, maybe Naveen, you can talk about your approach and what do you look at and how do you hold on to your winners?
Sure, Sonam. Thanks for this. So Sonam, just before going into the framework of what is high conviction to us, right? To set the context, we only run one strategy. So why do we run only one strategy? I think the philosophy has been very simple because our entire net worth is in the fund as promoters. Right? That was how we actually set up our AMC. It was a vehicle to manage our money first and investors' money second. Right? So for me, it was really important that this framework that we choose is an extension of what we and my analyst team believe in. Okay? And for the hallmark of a successful business, and different people have different hallmarks. For us, at least, it's a two-levered approach. One is cash flow growth. And analysts in general look at earnings growth, revenue growth, EBITDA growth. You can, in my mind, is a lot of this is manipulatable, right? The hardest thing to actually manipulate from a balance sheet perspective is cash flows. And if you look at history, not just in India, but US, there are two companies in the history of humanity which have manipulated cash flows. One is Enron and second is Satyam, right? So it requires a concerted effort from people in the system to manipulate cash flows. Very hard to do. More importantly, why is cash flows even important, right? Because for me as a promoter, when I'm planning for my business, let's say 1, 2 year, 3 years down the line, what's important is how do I reinvest this back into the business? Because that is what is going to drive future growth. I'm not buying past growth. I'm actually looking at buying future growth, right? Now, if I'm going to fund my future growth as an entrepreneur, predominantly through debt or diluting my equity, me as a minority shareholder, I have a higher chance of getting hurt over time. And I want to minimize that risk. So how do I measure that as an analyst? I look at return on incremental capital invested into the business. So if I combine the two levers, one, the businesses that have an ability to generate cash flow growth, and two, the return of incremental invested capital, potentially I have the ability to generate and hold on to my businesses from a higher conviction perspective. Now, coming to the second part of your question, holding period. I think holding period, we all want to be long-term investors, right? That's the aim when we run the fund. But things change along the way. Just because business cycles change and markets change, right? So, and the implicit nature of this change is one of these two things will eventually change, right? Cash flow growth will drop, which means you as an analyst need to take a call on whether it is structural or it's more of a temporary headwind that you're facing as a business, or return on incremental capital will actually drop. And if that drops, you as an investor need to actually take a decision whether you want to allocate capital to this company or you have an opportunity cost of holding on to this business. So typically we get into businesses with a shorter time frame of 3 years. And as the performance executes, as the business owner continues to execute, we would like to typically hold on to longer, but it is a metric of execution along the way. So that's how we think about holding period. So if I look at the fund, we've run it for 5 years. Our average holding period, though average is a misleading word, has been 3.5 years. The longest that we've held on to a business has been since inception. We've not sold out. And the shortest that we've done is 1.5 years. So it gives you a range of how we've looked at it internally at a fund.
Right. That's really interesting. And thanks for the insightful answer. Ashwin, would you like to, talk about what you guys do?
Yeah, hi, Sonam. I think some of the points, especially I think what Naveen just said resonates quite well. But if I can just take one step back in terms of the philosophy to set the context for how we do it. I think for us, two sort of big points. One is we try to look at what is happening at a business level and less on the price level. So a lot of our decisions are influenced by our understanding or our awareness of what's happening in the businesses. And that drives to a large extent the decision making. We tend to get less affected by or less swayed by price movements in the short term. The second point being that, in terms of just the philosophy itself of what we look at, I think the basic philosophy is that I think there will be a very, very large number of variability. I think there was some fantastic statistic that I was seeing the other day that if you look at, all the wealth that has been generated in the US in the last 100 years, I think less than, 1% of the stocks have generated that together. In India, we know that there is a very, very high level of variability in terms of quality, in terms of growth potential, in terms of, management capability between different companies. So I think the starting point has to be that winners are not easy. Winners are not plentiful. By their definition, winners are scarce, very few. If you get a bit of a jewel in your portfolio, you have to nurture it. You cannot get very complacent and say that you were able to get one. Let me look around, let me get 5 more or 10 more, because there are not that many in the first place. There will be very few and far between. And therefore, I believe that the starting point has to be that the bar you set yourself is high enough that you get the right winners, potential winners in. And then once you've set that high bar to get them in, you give them that elbow room to perform over multiple years rather than then questioning them for every quarter, or questioning them for every price movement correspondingly. So clearly from our perspective, it's about getting the business call right, getting the very, very high bar, very few businesses that should qualify for that bar inherently, and then back them for the long term.
Right, right. Yeah, so that makes a lot of sense. So from what I have heard from all the answers, right, that you guys have a very high focus on the quality of the company, the management quality, the earning quality, some profitability metrics, right? You want to look at high profitability, and like Naveen said, return on incremental capital, cash flow generation, things like that, right? But markets, as we know, are they shift, right? There are certain regime shifts where suddenly, like we saw in 2018, that the small and mid cap that were growing at a very rapid pace suddenly stopped working, right? Similarly, if you look at the past couple of years, momentum stocks have done much better than high quality stocks, right? So how do you manage to hold on to your high conviction stocks when something like that happens, when something like a switch happens in the market where, if you might have chosen a high quality company, it is being outperformed by a high momentum play? How do you manage to hold on to your winners then? So Ashwin, will you like to start on this?
Yeah, sure. So I think a fantastic point, and I think extremely relevant. I would see it in two parts. One is that it's the nature of the market to move in cycles, and as investors, as whether it is us portfolio managers, or it is the partners, or it is the end investors who are giving us their money, I think it helps everyone when you get in knowing that there will be cycles, and that whatever style you take, it's practically impossible for that cycle to work every time, right? And that style to work in every cycle. Once that clarity is brought in, I think that makes the decision making easier to respond to the point that you made, that if there is a clarity that I have a style, and in our case, if that style is towards finding that those businesses which can continue to compound earnings on a more sustainable basis, then that forms the bedrock on which you can then respond to how the things are playing out in the market. It doesn't mean that, or doesn't give us an excuse to become passive. It doesn't give us an excuse to completely sort of buy and forget. Absolutely not. What we have to do is to make sure, and I think Kunal and Naveen also touched upon that in their opening remarks, is that you have to be out there in terms of making sure that you're on top of these companies, what's happening from a business perspective. I think disruption is a huge issue, and is going to get bigger and bigger going forward. So clearly, I think complacency is completely not acceptable. But if you have clarity on what your style means, then these regime shifts, it becomes easier to tackle them. Because what we have to all realize is that, at the end of the day, it's not a very deep market in India. It's not a very liquid market in India. There are massive impact costs to making wholesale changes to the portfolio, especially if you're looking to operate at scale at some stage. And therefore, you have to give a very careful thought to how you want to look at these changes. So just to conclude my point, therefore, what we have tried to do, therefore, is make sure that we are clearly communicating upfront what our long-term style is going to be, so that we are not forcing ourselves to respond to every sort of regime change in the market, and hopefully investors understand that and stay with us through that.
Right. That makes a lot of sense. Kunal, will you like to add upon that?
Yeah, so I mean, Ashwin rightfully again has talked about the investor communication part. I think it's important. In addition, I'd just like to add that see these one can't be a winner in every single year. One style, I mean, it will never happen, and the record is like that. If you go back in time, different things have their time under the sun, and it's not natural. So as long as you're comfortable in your skin, and your investors know that you're not deviating from the process, I think it's fine. Though I mean, now this is a slightly, it's a slightly tricky thing. Then if you start getting into things whether I'll allocate a portion of my portfolio to that, and play around with satellite positions, etc. to an extent, but then you can't really be doing that in your core. The core will have to remain in one style, so to say. The other thing also is actually the styles that we are talking about now. And I understand that when you are talking about regime shifts and style shifts, these are more from a factor perspective. I guess because of your background too. But they also can be distilled down to the nature of the business itself and the duration of cash flows that one is looking at, and then the interest rate environment in which one is. So some of them you could actually deconstruct down to um, you know things that you could appreciate from a fundamental perspective purely, which is interest rates will affect a discounted cash flow exercise, and how far away cash flows are, or when something becomes profitable. So I mean, one very clear example in the last 6-8 months, Goldman Sachs I think maintains an unprofitable tech index, and I think it's a mighty number that it's down from maybe 25-30% down from the top that it made maybe a few months ago, and very coincident with interest rate movements. Now, if one is wedded to that style, that was bound to happen. But then, if someone was an investor in that space for the few years before that, they've also made a lot of money. Now, it's also incumbent upon investors then to reflect upon what they've signed up for. So these things will happen, but one has to maintain their own philosophy and go by that, I would say.
Right, right. Naveen, will you like to add upon this? It will be really interesting to see what you think.
Sure, Sonam. So I think both Ashwin and Kunal have nicely summarized a perspective that makes a lot of sense, right, from where they'll view things. So for us, like you rightly said, just in the last 4 years, you're already talking about 3 shifts. You're talking about small and mid cap, you're talking about growth, you're talking about momentum, you're talking about anti-quality. So, I mean, this keeps changing. So it's important for a fund manager to be true to their process, right, and not deviate based on narratives. But end of the day, the equity markets at a certain level functions on narratives, right? So as a fund manager, it's your fiduciary responsibility to blend narratives with numbers and establish that the story and the narrative along with the data establishes what you do, and that's what builds your conviction. So for us, our conviction from a numbers perspective, I'll give you 3 metrics that matter to us, right? Very simple metrics. One is your gross profit margin of a business. Second is the pricing power of a business. And third is the market share growth, right? I cannot tell you that all 3 contract, but I have a great long-term business, right? The narrative and the numbers don't match. So for example, in the last 2 quarters, you've seen logistics getting disrupted, supply chain getting disrupted, ports having issues managing raw material ships, as a result of which metal prices going up. So how many of the companies really have managed to even maintain their gross profit margin, let alone increase? How many of the companies have actually managed to increase their pricing of the products that they manufacture? It tells you a lot about these are the kind of companies that can not just maintain but also grow their market share. Right? What the market does in terms of punishing them or the businesses dropping 20%, that's not under your control. But when you have these trends being actually maintained during difficult environments, then you know that your conviction is getting maintained. Right? And the last part, I always keep harping on this, because when you have cash flows, you can either pay it in the form of dividends or buyback or reinvest it. And the investors in general don't like reinvestment into fixed assets. Why? Because it depresses earnings. As investors, we love it, right? Because end of the day, when the demand cycle is robust, that's what a company is meant to do, right? So when you get this combination, both from a narrative as well as a story, as well as backed by the actual data that we see on the ground as analysts, that's what builds our conviction, be it during bull or bear markets.
All right. Thank you for the answer. So in the next part, I would like to focus a little bit on the examples, right? I think, a lot of people enjoy when, fund managers, portfolio managers put out examples of the stocks that they have had to hold. I mean, they have had a success by holding, or, or situations where, you might have seen that, my conviction is not working out and I will have to exit this particular stock, right? So in the next part of the session, I would like to know about, instances where you have had to, make that decision to exit. And if you can add an example on, which is a high conviction stock that you held on to and which has been really, enjoyable for you, right? So Naveen, will you like to start off?
Sure, Sonam. So I think I'll answer this by first setting the context, and I'll give you examples on both the business that we've owned since this inception of the fund and we continue to own. Why? Right. And second, businesses that we've exited, though the narrative was extremely bullish, and why. Right. So, like I said, for us, an exit is an equally, if not more important process as a fund manager than just security selection, because we are active risk managers. I don't come from the school of thought that you can buy, hold, and forget great businesses and compound capital. It doesn't work in my mind, because we are risk managers at the very outset, right? So why do we exit businesses? Obviously, because business cycles can change and market cycles can change, like you highlighted, Ashwin and Kunal highlighted, right? And second is we are investing in people, and people change, right? When people change, capital allocation process changes. For example, Kunal has a certain style, Ashwin has a certain style, and if they move, their style changes. As a result of which, someone taking over Ashwin's shoes, I can't believe that he will run Ashwin's style, because that's unique to Ashwin or that's unique to Kunal, right? So for us, when managements change, we care, right? So for example, to talk about a business that we have owned since 2017 and we continue to add. So this is a space called CDMO or CRMO, which is in the pharma business. It's a company called Syngene. And it has its legacy for almost 25 years in India. And having worked in Hong Kong and seeing China very closely, I had invested in what I would call a 10 times larger mothership of Syngene back in the early 2010s called Wuxi Pharmaceuticals, right? So coming back to India, having worked closely on Syngene, I think gave me a lot of context from my prior career. So analysts hated Syngene, not now, since 2017. Pretty much most of the analysts, rest of India, had a sell rating for what it's worth, right? Why? Because PE was expensive, the PAT growth or EPS growth was muted at 11-12%. So you'll have to think back, not today, but think back in 2017. If I am buying a business at a PE multiple of 48, and you know where Nifty was in terms of a multiple 5 years back, Sonam, right? We're not talking today. So people obviously question. And the questions increase when the share price doesn't move over 2 years, right? Because your performance is what guides how you think you actually matter from a business perspective. Why did we invest, right? At a fundamental level, the cash flow growth was compounding at 24%. And what was the management doing with the cash flows? It was reinvesting it into fixed assets. So today, if I look at Syngene's market cap of around north of $3.5 billion, right? In the last 4 years, roughly around 10% of this market cap has been reinvested in capex. So as you can imagine, earnings are going to be depressed. Why? Because all of this capex is still not yet gone live. In pre-2016, the fixed asset turns of this business was roughly around 2.8. And in 2018-19, it was 1.2, right? Because capex is only getting deployed. And for the first time, the capex is going to go live over the next 2-3 quarters. So the conviction happened because although the earnings was depressed, the cash flow was robust and it was getting redeployed into fixed assets, which is going live now, right? So the demand cycle is still robust. Cash flow growth is strong. And we still believe that this is still on its early stages in terms of what we anticipate over the next 3 to 4 years. So that's how the conviction formed. And we continue to scale. It's done reasonably well for us from an IRR perspective. Now, in terms of an exit, right? If you look back, let's say 2.5 years, the narrative always was insurance is underpenetrated. India is great for insurance, and you need to be owning the market leaders. The narrative is clear, right? Nothing has changed in India over the last 2.5 years. And I think around COVID is when we significantly increased our stake in insurers. Two companies, HDFC Life, ICICI Lombard, market leaders in both life and general as far as we were concerned, and gaining market share. Now, three big trends that have happened, or three big levers for us to keep trimming, and we have our lowest exposure in insurance since inception today. Right? First is the market share growth. The market growth of APEs, which is called adjusted premiums, in terms of how you capture the industry growth, is roughly around 6% on a 2-year CAGR basis. Why do I say 2 year? Because 1 year is on a low base. So generally, I prefer to use 2 year because it will give you a more realistic sense of business growth, right? And on top of that, some of these businesses are actually losing market share. Not HDFC Life, but ICICI Lombard certainly is. Claims have gone up significantly because of what we've seen in the last 1 year. Along with that, interest rates rising, as a result of which your mark-to-market book will underperform short term. So from almost, I would say, 8-9 months back, we've trimmed our exposure significantly from a risk management perspective, right? So the narrative is still strong. The data, certain things have changed. And for us, we find better opportunities. So we have exited these businesses. Our exposure is at its lowest. And from our perspective, the narrative needs to match with the data. If not, we have an opportunity cost. And that's how we think about an exit.
Right. Thanks, Naveen. Thanks. It was a really insightful answer. Kunal, will you like to go next?
Sure, thanks. So in terms of conviction, and maybe I'll share an example about how research gives us confidence. So this is a situation maybe from 2020, actually December 19 end or 2020 start, the first quarter, is when I was carefully working on one company. And by the way, so just at the outset, disclaimer in terms of, that this is not for any of the names that I may discuss either by herself at this moment, but this is something from the past. So there's an amines player called Alkyl Amines. Now this December 19, I think maybe around the last quarter of 19 is when I started looking at it. And the interesting thing beyond the public domain, now again, beyond the material that existed around the company, which includes sell-side reports, which include what the management discloses in their earning calls. Now, in chemical companies in general, they all file environmental clearance applications. Now, the last years, there are even those who have started mentioning them in their reports. But it was something that was maybe not as widely followed or tracked. Now, this company within the span of a year had increased its filings to the Environment Ministry by, in spades, almost doubled whatever outstanding application they had. Now, there is also this catch that in India, because environmental clearance applications take time to process, it takes a few years. So, there's a kind of, not well, kitchen sink would be more than you want to invest into. And you hope that you'll get permission for a lot of that. So obviously, you could always say that within all of that, everything may not come online within the next 2-3 years. But the important thing was that the scale up in the application process itself gave some indication of what the company was seeing, the ambition, or maybe there are things in the business environment that are giving them that confidence to do so even. So actually, as the market was going down in Feb, March, this is an investment that I made maybe around the mid of March, maybe a week before the market bottom, and that paid manifold, subsequently over the next 15-18 months. So I mean, in fact, from the time one invested, I think it only fell. It only fell from day one, basically. Another 20-25%, and that's always a bit humbling, right? To see that no one likes to see red on their screen. So all of the people here, we don't like to see red on any position when we track, right? But you could see it unfolding every day. But then what one had seen gave one confidence that look, so I mean, that's example of just research that one can do. And I mean, would also like to state that at that point, in fact, I built down to the level of a textbook on a mines to get comfortable, because people say, the company says, well, we do a lot of pharma, we do a bit of agrochem. But then once you go and see the kind of drug applications, and you can correlate things that you're seeing in the filings, gives only, gives you much more confidence about what the company is saying. And the beauty was, I think, that the company was very reticent on calls, but in fact they disclosed far more in their environmental clearance applications in terms of direction. In the calls, they would say, we can't comment on this or we can't comment on that, because that's just a stance they've taken for a long time. But when you had a document which anyone can Google and find out which was right there. So an example of that. In terms of exits, I think one has to be dispassionate about what one sees. So there is, and you should be exiting sometimes even when things look all right. In fact, most people will be saying that things look the best right now on the business level, but sometimes at best is maybe not the best from the valuation perspective, for sure. So one should be, in fact, pressing a button if things are completely in euphoria zone and stop making sense from a valuation perspective. So again, I had done that even, there's an example from last year where something just went up 2-3x in a very short span of time and stopped making sense from a valuation perspective. So it's seductive. The prices on the screen sometimes can be very seductive, but you should keep your own thresholds and apply them. So I mean that those are examples. So I think exits need not only be because what you started asking was when things go down, what do you do and how does your conviction get tested? I think it's even when things are too good, how are you handling things?
Right. No, that's a great answer. Ashwin, would you like to comment on this?
Yeah, sure. And I think both have been quite detailed. I'll just try and give you a very quick summary from my side. I think before I get into it, Kunal made this point and I'd really love to it. I think in many times, in Indian market, volatility can be a pretty useful friend to the portfolio manager. And instead of getting scared by these price movements, if you have a good handle on the business, then you can use that to sort of and I mentioned in one of my earlier remarks that even if you want to hold some business, it doesn't mean that you become passive. You could always adjust your holdings, even though the stock remains in your book, but you could always sort of tweak your weightages and you can play around with some of those things to take advantage of opportunities. And that has been quite a powerful sort of vehicle for us historically. Coming to your original question, I think I'll just keep it quick. Like I said, maybe one big theme for us in the portfolio and across 3 or 4 stocks with the entire private sector lenders. And I think we all know how the scenario changed post-COVID for that space. Interestingly, it was an area which had a pretty secular growth environment in a market which was starved of growth historically. And post-COVID, we had the sort of perfect storm where on the one side, you had NPA concerns, on the other side, you had massive challengers in the form of new age fintechs which came up. Suddenly people had to revisit some of the core assumptions in that space. It was a painful period for us. And I think that's clearly, I mean, what it tells you, I suppose, is that, and Kunal, I think, mentioned this, and I'll resonate, is that things can go along pretty well, but you can get blindsided by developments. So it's important, I think, to be able to take decisions, not fall in love with the position. If we need to take decisions in light of changed environment, then you should be able to go ahead and do that. We did whatever we had to do, but I think, clearly these are things that will keep happening from time to time in the market, and you need to be able to respond.
Right. No, that's a great answer. So talking about high conviction, we at Right Research, we took a high conviction bet on the new age companies, some months ago, and, it hasn't panned out well for us, right? So I would want to know, I'm sure, I hope we have reached the bottom, right? But I would like to know from you guys that, what is the theme or, a particular idea on which you will take a high conviction bet right now? So Ashwin, would you like to start on this?
Yeah, sure. I think I mean, there are some themes which are obviously going to be evergreen in India, and I'll not repeat. But since you mentioned technology, I think that's clearly one theme that we believe, with a reasonable horizon, let's say a 3-5 year, I think will be a game changer in the Indian market. Whether you see it from a top-down macro perspective in terms of just the sheer quantum of business volumes that will start flowing into these companies, just the market opportunity that they will be looking at, as well as if you look at it from a bottom up, just in terms of just so many of these companies, they're gaining scale, they are going to get valuations, they are going to get listed. Obviously, there are a few listed already. And from our perspective, yes, the market will struggle to figure out a good way to value these businesses. Yes, therefore, you will have to deal with near-term ups and downs, because sort of we are still finding our feet as a market on some of these businesses. We've never had those sectors even in the listed universe before, some of them. But I think as a theme, this is going to be a pretty secular theme. I'll also add that this is from a point in time opportunity perspective, this is going to be a massive play over the next year or two, and a lot of these businesses are going to come on stream in the listed space. And maybe if I were to contrast what has happened in the US or China, just to take the two biggest markets, with what is happening here, we're probably trailing them by 5 to 10 years. And I mean, just look at how large the listed tech space is in the US, and indeed how large it has now become in China. And I mean, in terms of just the businesses underlying addressable market, it's all there. It's just that in the listed part of the market, we are not seeing those things play out yet, but I think it's a matter of time. So it's a big theme. I think it's going to be a huge theme in the next 12, 18, 24 months. Clearly something that we are very excited about. Ups and downs will happen. I mean, equity market, you have to learn to live with volatility. You have to learn to handle risk in your portfolio appropriately. And obviously those are things that we will need to do. But as an opportunity, I think it's tough not to get excited by what the dramatic sort of growth and change that these players are bringing in. It's just breathtaking, frankly.
All right. So it's great to hear that, Ashwin. Now I'd like to ask Naveen. I really like his approach of finding high conviction winners. So what is the theme that you are betting on?
So Sonam, I think it's very easy to piggyback on you and Ashwin, right? And because we do own consumer tech, right? So I'm not going to go down that route, because let's not go down the easy route. So I think there's a theme that we personally like at ITIS, which is a very non-sexy, misunderstood theme. It's called contract research and contract development, right? Predominantly for the Fortune 500 pharma companies. Why do we like this theme? Because India has always had an edge there vis-a-vis China. And now COVID has accelerated that theme in terms of diversifying partners away from China. This is a B2B business. And as you are aware, Sonam, B2B is generally non-sexy. Just if I was to give you an example, just think about Microsoft 3 years back, right? No one even spoke of Microsoft. No one even speaks about Microsoft Teams. Very few people are aware Microsoft Teams has actually crossed Slack in terms of the number of users globally. So they go about doing their work in a very quiet way. And it's a very sticky business. Once you work with a partner in terms of outsourcing your research, you wouldn't change it on every year basis, right? And if you are able to backward integrate that into contract manufacturing, you have a very, very sticky business. So I think this is a theme that will play out in our mind over the next 5 to 7 years. And there are very few players who are even equipped to be doing this at scale. Many people will come, many people will go, but this requires 15, 20 years of expertise. And I think for the patient investor, this can be a fairly significant wealth creation opportunity in India. So that's the theme that we would want to be playing out.
Great. So this is something that all of us learned today, so which is great. I'll ask Kunal last on what is the theme that he wants to bet on.
So we have been making changes to the portfolio in that direction too, and companies which are in the manufacturing space, I think industrials, not necessarily in industrials only from the perspective of capital goods, but certain manufacturing companies in general. I think exports are shaping up well for multiple companies. And interesting thing is when you see similar commentary, uh, maybe not only from one company, but its supplier, customers, or when someone is talking about very generalized demand that is coming through from industry in general. And there too, I think the writer that I would say is preferably things which are more driven by private capex. Just to give one example, I mean, the metal sector has so much money now. I mean, in December 19, if one spoke with the steel company management, I'm not sure. I mean, most of us, you're just about hearing news about COVID in the last week of December. But whatever subsequently happened has delivered so much money in the hands of metal companies. When they do capex now, I'm not sure they also would have known that such a windfall was to happen in the next 2 years. But now that they have money, they are spending. So beneficiaries of those are where we are spending time on, in a nutshell.
Right. All right. So we have had a very good discussion today, and I think I learned the lesson that holding on to high conviction winners can be a fruitful journey. So we'd like to conclude with